I view investing in special equity a form of absolute value investing. Now that is a hard concept to embrace. It's not a term that's often used in terms of investment approach other than the outcome. People speak of absolute returns. But the investment selection process being absolute is a concept that basically says it's devoid of market considerations. The companies that I select, I believe, are absolutely attractive, irrespective of where the market sells, because they're not tied to market valuations, or for that matter, obviously, peer valuations. It basically asks the question, which is, a question that buyers of anything should be asking is, what am I getting for what I'm paying? And in finance, we actually have terms for that. What we're getting is called the cap rate, the return to the buyer. It's often used in real estate, but it applies to equities also. So I use a definition of what we're getting that is very conservative. So what do? We have to look at earnings. Most people, when they look at earnings, they look at forward earnings. I use the lower of the past 12 months or future 12 months, whichever is lower. So we're compressing out, we're removing expectations. And then in the earnings, further definition of earnings, conventionally in business transactions, mergers and acquisitions, private equity deals, the earnings number that's used is earnings before interest, taxes, depreciation, and amortization, commonly known as EBITDA. It's a big number, so a lot of letters, a lot of numbers. I use a smaller acronym called EBIT, earnings before interest and taxes. I don't include depreciation and amortization. I give no credit for depreciation and amortization. Depreciation is clear-cut. Depreciation is an ongoing expense. If you stay in business, you're going to have to buy more capital equipment and so forth. Amortization arguably is a little more controversial, and many people do add it back. In terms of being ultra-conservative, I don't. So again, using that lower trailing 12-month or future 12-month EBIT number over enterprise value. Enterprise value is what you're going to pay. It's the market price times shares plus the debt you assume minus the cash you get. So that establishes the cap rate. That's the return we would earn buying this asset. Then the next question is, well, what would it cost us to finance that acquisition? And obviously, presumably, you would only do it if there were a spread, if the cap rate were significantly above the cost of financing. We constantly seek to buy things where the return to the buyer is higher than the cost of financing to the buyer. So ergo, it has absolute value. If we're comfortable that the earnings level, that trailing 12-month number can persist, you have to do your homework and come away with a comfort that that 12-month EBIT number will persist. And that's where the mistakes are made. It doesn't always persist. Something comes about in the world economy. The business model all of a sudden breaks down. There's a destructive competitor out there, whatever. So, but if you can do that, it's the essence of what mergers and acquisitions and private equity is all about. And interestingly enough, because I have invested this way in public mutual funds since May of 1980, so that's 36 years now, we have a lot of data points in terms of daily NAVs. It's remarkable how when the market does poorly, this absolute value kicks in and gives some support. It doesn't mean we can't go down and lose money. We can and do. But historically, one of the reasons the special equity small cap fund, which goes back to '98, has such a low downside capture ratio, I would argue, is because of the absolute valuation